What is up, my friends? Welcome to another global economic report. Today, we are going to talk about the S&P 500 and this Fed rate hike, which is literally about a week or so away. That's going to happen in the United States, and just what's really going on here and what this means, okay? So first off, let's go back in time 4 days to Friday, December 7th. Dow tumbles more than 500 points. It was also during this period that $1 trillion got wiped off the books. Wipes out gains for the entire year of 2018 to cap a wild week on Wall Street. Now, the stock market in general in 2018 has been more volatile than anyone ever expected, or what most people are used to. It's usually nice and slow, fairly boring, unless some big news breaks. Now, in the crypto space, to see gains of 30%, down 80% through the year, the volatility is much different. So me naturally coming from that market into looking more and more into the traditional stock market, to me, this isn't all that bad, but I see to where somebody who's used to that, again, it's perspective, right? Overall, there's so much stress and pressure happening that I feel personally, if the Fed does this rate hike in December, which we're going to talk about, that we will be well on our way into recession territory. I think that we are. The way to avert it, or divert it rather, would be to delay this December rate hike, which now there's some people, the head of the St. Louis Fed came out recently and said, James Bullard, and said that they should postpone it. Anyway, I'm getting ahead of myself here. So, rough week. A weaker than expected jobs report, and obviously the China-US trade tension sent the Dow Jones Industrial Average lower by 558 points to 24,388 and erased its gains for the whole year. At one point, the Dow was up more than 8% for 2018. The S&P 500 pulled back 2.3% and also turned negative for the year. The NASDAQ composite dropped 3%, and shares of large cap tech companies led the way lower. Facebook, so the FANG stocks, all also traded lower. Apple stock fell 3.6%, also too erasing its gains for the year. But hey, that wasn't so bad, right? The next day, maybe it got better? Well, no. So by Sunday, we had more volatility. So here's 2 days later, Dow erases 500-point drop and closes higher in another wild session on Wall Street. So what we just read 2 days before had now completely corrected itself. The Dow Jones Industrial Average closed 34 points higher, erasing a 500-point drop. The S&P rose 0.2%, and the NASDAQ composite jumped 0.7%. Facebook stocks rose 3.2%, while Amazon, Netflix, and Alphabet all rose more than 0.6%. Apple, meanwhile, erased a more than 2% pullback to close 0.65% higher. What is causing all this volatility? Well, there's not only the tensions between the US and China, which are made worse by the arresting of Meng, the CFO of the Chinese Huawei company, which is a big tech company, and there's some weird things going on there that I'm starting to look into, with all these countries banning it and standing up against it for the 5G rollout that they wanted to do. Very interesting stuff. So I just started looking into that, but anyway, she got snagged up on Sunday in Canada for the US essentially, which just shows the reach that the US has in, I guess you could say, digital and non-digital matters. So we have that whole thing going on. But let's not forget, we still have Brexit and the interest rates still going on. We have protests that have been going on for 4 weeks in France, which I think a lot of people at first were thinking, oh, the French are always protesting, but now there's more truth starting to come out to like what's going on behind the Yellow Jacket movement. And so I think that's interesting, and that's adding to stress and pressure. We have new breakout protests happening in Thailand now. I don't know if this is a continuation of the Yellow Jacket movement. I just started looking into that today, or if this is a completely new thing, but we have an uptick in global turmoil that doesn't add to confidence when the debt numbers of the United States are so widely known. And anytime anything happens with China and we see pullback because of that, then it adds more uncertainty. Like Apple dipping had probably to do with the trade wars, because the fact that they outsource so much of the tech and so much of the building out and the creation of these phones to China. We're seeing now more than ever directly that news pieces are swaying the markets, 100% swaying the markets. So let's dip into the next piece now, posted 11 hours ago. The Fed, if it keeps hiking rates, will cause a recession. ex-Trump economic advisor Stephen Moore suggests. The only thing that really worries me right now about the economy is what the Fed is doing. He's not the only one to say that, hey, look, the Fed needs to stop increasing interest rates because we're risking a recession. This will be the fourth time that they do it. I believe it's going to happen this week, but he's not the only one to say it. We have the St. Louis Fed head, James Bullard, saying similar, that they need to delay the December rate hike. He cites the inversion of the yield curve earlier this week as reason for caution. That negative or inverted yield curve is really concerning. It's been talked about now for the last couple of weeks within economists and talking heads on social media. But I find that it's interesting that even within the Fed itself, they're saying, hey, let's not do this. Obviously means that they're starting to see what's going on and that there is some serious concern here to be had with what's going on. On Monday, the 2-year Treasury yield moved past that of the 5-year Treasury notes. A negatively sloped yield curve often signals an economic recession, though the time between inversion and GDP downturn has varied widely over the last decades. As of Friday afternoon, the yield on the 2-year Treasury note held lower at 2.7%, while the rate of the 5-year note was at 2.718%. So here's the look at that. These are big indicators for economic slowdown and economic recession. But I think overall, 3 rate hikes for 2018, that's a decent amount. It's higher than most years. 2017, we also saw quite a few rate hikes. But overall, if they were to slow down with this right now, and it would allow the 2018 to potentially end on a high note and possibly see another rally, because I assume that FANG stocks, S&P 500, DJI will all just bounce and we'll see higher highs if they delay this rate hike and they continue quantitative easing through the fourth quarter here. So we have seen now in October, November, and the first week or two of December now being the most volatile months of the entire year in the traditional stock market. And there's a lot of other interesting things going on right now. The NASDAQ 100 testing post-2009 uptrend again. What you see is when a trend line is established, it takes 3 touches for it to be established, okay? So we got our third touch there. I know this is a little small, but what it looks like is that we're getting a retesting within a short amount of time on this line again. So if you continue to test this zone too much, or this line of support too much, you'll break below it. But what we traditionally see is double bounce and then it goes back up. It's called a W. Whereas when we see an M, that usually suggests a downturn. When we see a W, that usually suggests an uptick or some sort of bullish indicator, okay? So right now, we're getting that retesting going on of this support that has acted as support since 2009 on NASDAQ. Okay, it gets worse. Deutsche Bank, if you've been following this channel, my prediction, I've been very loud and very vocal about this, is that Deutsche Bank will be going down this year. I know that we're in December already, almost midway through December, and it hasn't happened yet. I'm perfectly okay with my timeline being wrong and it extending into the first quarter of 2019, but Deutsche Bank is literally on its last legs. Here we see a testing of lower lows, so we see a downtrend line. So here we've got 1-2 touches, another test there, and another testing here. Once again, testing this downward, I wouldn't even call it a support line, but it's more of a downward channel that is being tested once again, and that is not a bullish indication. Next, we see the MSCI Emerging Markets Index has now broken through and bounced back up through this downward or descending line of indication, and now it's testing that as support. So this is kind of do or die here as well, that if this doesn't bounce and continue its upward trajectory, then you can expect a further breakdown. There's going to be different zones. Some of them you can just clearly and obviously see here, just horizontally, you can see different zones that it would then have to go and see if that will act as support or if it'll break that support. This being a big one right in here, this little pocket. So it looks like we're breaching into that territory right now. It is testing this area, and this is do or die. Total returns of various asset classes between January 29th and December 5th. This is a really cool chart. MSCI, EM, and EAFE, gold. These are all negative, by the way. These are all negative returns. This one is almost break even, and this one is not I'd say it's about 1% US cash. 10-year US dollar treasuries. We got EM debt, MSCI US, gold. You get the point. Everything is showing a negative return so far through 2018. Also, what's been happening through Q3 and now Q4 of 2018 is foreign countries are dumping US treasuries. They're doing so in a fairly big rate. So what we've seen is the dumpers are Japan, China, and Russia pretty consistently throughout Q3, Q4, and the big buyer has been Saudi Arabia, which, remember the fiasco and some of the stuff I was talking about over the last couple months with the news reporter getting killed over in Saudi Arabia and in kind of this cover up and the US's stance on it. Tricky territory, because whether they wanted to really hold them super accountable or do what they would traditionally do, they at the same time can't deny that Saudi Arabia has been consistently since Q3 of 2018 a huge buyer. This is a good piece. It just talks about a lot of what's happened up until this point. Russia's central bank has sold some 85 billion of its total 150 billion US holdings from April through June, and if you remember, there were sanctions placed on Russia back in the beginning of the year. I know it's tricky to remember that because there's been so much that's happened since then, but now we're in Q4 and we're starting to see trade sanctions placed on China, and consistently through this last couple months of these negotiations happening or lack thereof, we see China starting to dump off some of its US treasuries as well. What people need to be aware of is that, China is going out with its own initiatives and trying to push its own dominance with not only the One Belt, One Road initiative, but some of the things that it's doing in Africa and, just traditionally how they do business throughout Asia. Most people in the West don't know what they do, but they have their hand in a lot of different things. They are constantly getting involved at the country level, at the government level for loaning money and loaning other assets that they then later on get to come and cash in on. So I think it's important to remember that. So that's all I've got for you today in this video. If you like it, click the like button. If you want to talk about something, go ahead and place a comment below. If this is your first time to the channel, take a second, click the subscribe button, hit the bell notification, and be on the lookout for more videos dropping soon on the channels, my friend. Okay, bye.